Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I'd love to get his insights on a lot of different markets. He co-founded Macrovisor and TraderAid with Aisha Tariq. You see her on Fox Business, CNBC, Bloomberg almost every day, Monday through Friday. Markets and Mayhem, thank you for joining me again.
Hey, Jason, thanks for having me back. It's a pleasure to be here.
So Mayhem, we're recording this interview on Tuesday, May 28th, 2024. The 10-year US Treasury yield, it's been a roller coaster for the last 6 months. It's back down to around 4.5% on the yield. It did get as high as 4.7%. It looked like it was going to go to 5 only a little over a month ago. Got back down to 4.4%, I think, in the last 10 days. It's gone up a little bit again because the market, I guess, is not getting its rate cut immediately. But first, before we talk about maybe interest rates on the 10-year US Treasury yield, and if you think that that could be a headwind or a tailwind, depending upon which way it goes, I'm going to get your thoughts on Nvidia. Do you think that Nvidia is dragging the general US stock market indexes higher?
That's a great question. I think it depends on what time frame we're looking at. So if we talk about the last week, absolutely. Over the last week within the S&P 500, Nvidia is up 20%, with the rest of the market not nearly bid that well. Now, Qualcomm and AMD each up over 7%, GE up over 5%, but you look around the rest of the market, those types of gains are very unusual, and there's actually a sea of red in a lot of the S&P sectors. Now, you zoom out a month, it looks a little different. There's a broader distribution of upside over the last month. You've got, Eli Lilly, Apple, Meta, a lot of the semis, Netflix, all well bid, and Nvidia, of course, leading the pack up almost 30%. And then you zoom out year to date, Nvidia's up a staggering, we're just going to look at year to date. I had 1 year on screen, but still it's up a staggering 130%. But Google up 26%, Meta up 35%, Eli Lilly up 38%, Micron up 55%. So there's some distribution. I would say that what Nvidia represents is helping to pull the market higher. And it's part of a key theme we've seen since early 2023, which is that the AI pick and shovel sellers are leading the way. Companies that are at the top of this pyramid of growth or expected growth in AI are really having the better part of the rally. So obviously Nvidia is a big part of that, but we've seen beneficiaries like Qualcomm, Micron, Meta, Google as well in that pack, to a lesser extent Microsoft and Amazon. And I think that that narrative is what's helping to really drive a lot of the returns in the market. Some of it real, that is to say, some real earnings and revenue growth, Nvidia being a key example of that, but some of it a bit more speculative in the sense that just the presumption that growth will be a future phenomenon for some of these companies kind of riding the tailwinds of AI, particularly the no profit, lower tier growth companies that are more speculative. So I would say that the theme that Nvidia is sort of the poster child for is a big driver of those returns that we've seen really over the last year and a half at this point.
So the Mag 7, it's what, down to Mag 1 or Mag 2?
Yeah, I would say that if we look at year-to-date performance, we could say, it's Meta, it's Google, it's Nvidia, it's Amazon, it's Microsoft. So there's still, maybe 6 of them that are still kind of firing to some. Well, we'll take Tesla and Apple out. So it's really the Fantastic Five. Right, those are the ones that are really firing, better than the market overall. And then the ones where the growth is really concentrated, it's Nvidia, Meta, and Google, right? Those are the ones that are absolutely just running circles around the broader S&P. So you could say it's either the Fantastic Five or the Terrific Three, depending on how you're benchmarking it. But I would say that that key theme, that AI-driven rally, has been what's lifted animal spirits. And it has been a somewhat concentrated rally in the sense that a lot of the outperformance is from these larger players. And now that sort of so-called Mag 7 is over 30, by some measures, 31% of the S&P 500's market capitalization. But on the other side, those same companies are also, up to this point, leading earnings and revenue growth. So it's not just money flowing into there without reason other than a narrative. There is some improvement at the fundamental level, albeit maybe getting a little bit frothy here, but nevertheless justifying some of the cash flowing into these companies.
So if I could summarize what you just said in the last couple of minutes, you think that the market is starting to reposition itself. Maybe it's because that book from Lawrence McDonald came out, When Markets Speak, that a lot of major hedge fund managers bought that book and have read it or listened to the audiobook recently, where he lays out a lot of the trends that you're talking about with artificial intelligence, data centers, copper demand, electricity usage, demand growth. And so you're starting to see portfolio managers that are more generalists or institutional investors. They've been allocating to, say, copper miners or data center real estate investment trusts or electrical utility companies, which have started to outperform. They're allocating capital to those industries that they never would have allocated to in the past.
Yeah, and I think it's starting to kind of get to this point where it's not just about who are the pick and shovel sellers at the top of that AI pyramid. It's also about who are the beneficiaries in some of these other sectors and industries. And so we see those tailwinds because when we think about what does this mean? And it's not just AI, but AI is a big part of this. It's also reshoring of manufacturing, people wanting to plug in this increasing fleet of electronic vehicles. A lot of that's also adding to power demand and on the periphery to some degree crypto mining. And so as we see that increasing power demand, you've got more need for copper, more need for energy exploration and production and generation, as well as transmission. And so you have this whole kind of trend that's taking place in the older economy that's helping to lead some of these returns in copper miners and some of the energy companies that are especially some of the better positioned ones. You also see some of that, like you said, in these data center services companies. I mean, a company that very few have heard of, but has outperformed Nvidia is VRT or Vertiv Holdings, and they're really one of these companies that services data centers. So they're a little bit more in the manufacturing the products that go into data centers, and it's very interesting to watch how companies like this, they've been like tenfold up over the last year essentially. Um, and this is sort of part of that trend that some of those smaller beneficiaries can either perform or outperform significantly the leadership like Nvidia. And to see anything outperforming Nvidia is obviously pretty amazing. But I think that that's part of this broader trend that AI power consumption, increased growth of data centers, in no small part because of AI and AI related operations, but also because of increasing digital transformation, increasing usage of the cloud, higher storage densities, greater compute requirements, more data to process, more automation to engage in. A lot of things are happening where huge industries and government bureaucracies are moving everything from traditional data centers and self-hosted facilities into the cloud as well. And over time, that grows, right? So that usage grows and it leads to greater demand and greater hardware utilization. So it also means you have other beneficiaries like the companies that sell the networking products into data centers for switches, routers, perimeter security, the Arista networks, the Palo Altos of the world, and other companies in that space. And then there's, of course, utilities. Out on the East Coast, Silicon Valley, you've got companies like Dominion that serve a lot of those data centers in Northern Virginia. And their key beneficiaries of this is data center power requirements are set to triple over the next 3 to 5 years in areas like that. So I think it all kind of shapes together where you have a number of beneficiaries that are outside of conventional thinking. And like you said, asset managers are starting to get more involved with that. And then you have the sort of horizontal beneficiaries like you have the Qualcomms, the Broadcoms, the AMDs, the Microns, the Western Digitals, the Seagates, Taiwan Semis, and others that make some of the other equipment that may not be seen as quite as exciting or having quite the same profit margins as NVIDIA, but nevertheless are seeing a torrent of sales because you still need more storage. You still need more flash memory. You still need a lot of these core building blocks for this data center growth that's coming online.
And the data centers burn through new semiconductors, new chips, whether it's Bitcoin mining or next generation data centers. Every couple of years, they have to switch out to new semiconductors, new chips, new servers. So there's a lot of upgrades of the technology, the hardware, the software, and then also the electricity demand usage projections. You've been posting these electricity demand usage projections on your Twitter, some of the charts. Now, the estimates are not all in the same amount, but some of the low end estimates between now, which is 2024, mid 2024, and 2026 to 2030. I mean, there's a lot of projections that say electricity usage globally could double. And I've seen other ones. Lawrence McDonald has said publicly in interviews, because he's been covering this trend. He wrote it an entire chapter, I believe, in his new book that a lot of Wall Street money managers bought. I think he said publicly that by mid 2030s, he said potentially electricity demand usage. So this is baseload electricity because of China, India, more people using electricity on the grid for the first time than all the data centers. He thinks it could potentially go up 4x or 5x.
Yeah, so I think there's going to be a kind of push and pull here, because on the one hand, I think there will be all these trends are taking shape as we've discussed, right? Greater data center usage, more emerging and frontier markets coming online, needing generation and transmission. A lot of these trends are going to be themes that continue. On the other side, I do think we'll see greater and greater energy efficiency at greater scales as well within technology, but also within some of the average everyday things that we're doing, where we see, energy efficiency as a key trend. So I think there'll be some degree of offset from the efficiency versus the total amount of growth that we see. So in my mind, it looks more like, 2 to 3-fold over that same period of time globally. But, of course, anything is possible. What we know is that we don't have enough energy, and that there is some degree of scarcity. And this is a theme I started to talk about in 2022, this theme from abundance to scarcity. Some of it is artificial. Some of it is natural, in the sense that we are running lower on certain resources, but other times it's more from regulatory issues or other restrictions. At the end of the day, that means we have less than an abundance of energy, less than an abundance of key industrial metals like copper and platinum, less than an abundance of arable farmland, less than an abundance of clean water for growing food, and also less than an abundance of labor in markets with increasingly aged populations that are retiring early because of, the way the market is run and how they become more asset rich. A lot of this leads to sort of inflation at the baseline becoming more entrenched. And so when we look at going back to the 10-year note, I think that the interest rates that we've seen on the 10-year note, this is something that's been a benchmark for me, about 4.5%. And I talked about it earlier this year that I think if we move rates above 4.5%, markets could get a little bit more stressed. As rates did move above 4.5%, we did see volatility make a little bit of a comeback, more in realized and implied terms. And we're starting to push above that level now. But we see a feedstock for higher concerns about future realized inflationary trends. And that's in the form of higher commodity prices. That's in the form of global PMIs showing prices paid and output prices on the rise, which typically has a 3 to 4 month lag before passing through to various inflation measures. And we see that with surveys of businesses also saying they intend to raise prices where they can to their customers, trying to at least offset inflation, if not increase margin where there's pricing power. And so I think on the one hand, this means there are some cyclical and secular trends taking shape that favor some of these older economy plays that have pricing power in an environment of rising inflation. I think it also means we have growing risk in some of the more speculative parts of the market that may not be as favored in an environment of rising rates, particularly unprofitable companies in more rate sensitive areas like the Russell 2000.
And if the 10-year US Treasury yield continues to rise, let's say way above 4.5%, it goes to back to 4.7%, or even heads to 5%. I think that's going to be a headwind for a lot of companies, especially the small caps, like you said, but other sectors and industries as well.
Yeah, like regional banks where they have a lot of their exposure on their loan book and in their assets to things that are sensitive to the rates on duration, and particularly that 10-year, that could cause some pain there. When you combine the unprofitable growth companies with the regionals and the Russell, it's over half the index. That's why it trades lockstep with the price of the 10-year note, because there's so much of it that's sensitive to rates that it pretty much is going to move with rates. So inverse to rates, lockstep with the price of the 10-year note. And it's interesting to see that. And then the divergence between the NASDAQ, where the biggest companies in it are actually favoring higher rates because they have larger net interest cash as they refinanced all their debt in fixed terms back during the COVID lows. And these smaller companies have to deal with revolving lines of credit, whatever the prevailing rates are, what they can pay if they can raise cash at all. And so these are sort of a series of disparate outcomes that illustrates that K-shaped economic recovery as it concerns the size of companies and the prevailing interest rates that they're either earning or paying as well.
One of the best examples would be Apple, because Apple has a lot of cash. Yeah, they have a lot of debt and they've done financial engineering with share buybacks, but they also have a lot of cash. And so they've been one of the main beneficiaries of earning all that extra interest on the quote unquote risk-free T-bills, because they can just park a lot of cash there and earn over 4% quote unquote risk-free.
Exactly. I mean, they have a pretty good configuration in that sense. Google, Amazon, Microsoft, Meta, they're similarly positioned in the sense that they have a lot of short-term exposure. They earn net interest income. It's something that we kind of have to keep in the back of our heads, because the other thing is, as rates eventually do come down, and at some point they will, that's going to be something that these companies have to deal with and be able to offset with increasing margins to make up for that loss of net interest income. So at some point, cutting rates actually becomes a bit of a headwind for the biggest beneficiaries of that net interest income. But I do think in the near term, the 10-year, to me, the way I look at it, it's more of a proxy of the treasury market and the overall credit market's opinions of the economy and inflation moving over a longer time horizon. And what you're trying to price in is, if I'm buying something with 10 years of exposure, what does the dollar look like over that period of time, right? How much currency risk am I running for depreciation? And also, does that prevailing interest rate pay in excess of what I believe that depreciation will be? And on top of that, am I earning some kind of margin for the risk, that premium that I'm taking? And the problem is that it doesn't. At 4.5%, when I can get about 5% on bills, it doesn't make any sense for me to buy tens, right? And what I like to also say is, look, if I can buy 30 days of exposure in excess of what I'm getting paid for 30 years of exposure, to me, that lack of a term premium makes it much less attractive for me to buy the longer end of the yield curve. So I don't really see a powerful reason for fixed income investors to want to get really longer term treasuries. I still think it makes a lot more sense to ladder bills. If you want longer duration, there's AAA corporate debt that's not too bad. There's also tax-free municipal bonds that kind of fit in the middle in terms of their duration. That's where I'm parking my fixed income portfolio, because at the end of the day, if we do see a greater term premium, let's say we see, God forbid, 6% on a 10-year, and we have a delta between that and maybe 4.5%, 5% on a 2-year, that's where I'll be more attracted to considering getting some exposure on that longer end, maybe nibbling around the edges. But right now, given the fact that risks to inflation remain to the upside, that there's a lack of term premium, and we've seen some not so great auctions today, with the 2 and the 5 being C grade based on what I was seeing, lower demand and a bit of a tail on each auction, I just don't get the sense that interest rates have a path lower from here on the 10s. Now on the 2s, I look at this with a little bit of difference. I look at the 2s more of a proxy of the market's opinion on where rates are going to go. So it's more focused on the Fed. It's more focused on policy outcomes. And so, with the 2s, they've already given back a lot of their recent gains. So they might be closer to sort of an interim high in rates, unless the narrative really becomes a hike is coming next rather than a cut. Kashkari talked about that a little bit recently, that a hike is not off the table. Personally, I think it kind of is. My more cynical view here is that the Fed makes a policy mistake. They cut once or twice. They reinvigorate inflation, and then they have to either pause or potentially come back to the table and hike after that. Because what we've seen the Fed do habitually throughout its existence is make mistakes and then try to correct them reflexively.
And when they do a 180 on their policy, normally it's to an extreme, because in the past, what they hadn't, for the last 15 or 20 years, they hadn't done what 3 rate hikes at the same time before. And they did that in a bunch of different meetings.
Yeah, they've done some things that I think were pretty aggressive on the policy side, but I also think there is some nuance here. And this is one of the things that we've heard, really in the echo chamber of social media in 2023. The Fed doesn't matter, you can fight the Fed, et cetera, et cetera. And I understand where that sentiment was coming from, but I also think that it's important to consider all the moving parts in the market. So on the other side of it, for the first half of 2023, there was no debt issuance by the Treasury, because we had that debt ceiling debacle really extended to the last moment. And I think by design, to improve liquidity conditions. In doing so, it more than offset and sterilized the Fed's tightening, both in terms of the impact of interest rates, but also in terms of the impact of quantitative tightening on overall liquidity. Then in the back half of that same year and into this year, there's been this enormous fiscal excess. In fact, it's the largest percentage of deficit as a part of GDP that it's ever been with unemployment, I should say, this low. So the largest deficit spend as a percentage of GDP with unemployment this low, spent to try to stimulate the economy ahead of an election year. And I think that a lot of that more than offset the Fed and actually created some of that excess of demand that supply isn't able to meet or absorb. And that's starting to bring back inflation, just as we see emerging markets starting their new credit cycle with rate cuts and with some degree of stimulus. And global fiscal stimulus is also on the rise. So there's this sort of offset where the fiscal side more than offset the Fed's aggression. And so even though it seemed really aggressive at the time as we were experiencing it and saying, wow, this is one of the most aggressive rate hiking cycles, when we view it through the lens of financial conditions and we view it through the lens of aggregates of liquidity and otherwise, taking into consideration the fiscal impulse, it's actually been negligible in total impact. Sure, there was a period in 2022 where it hit harder, and you might say we had a 2-quarter mild technical recession, but the government came back in with so much fiscal excess that it more than offset all of that. And I think that's where we are now. We're at a point where this fiscal policy has become so excessive and it's leaning so much on the demand side that we've extended a very long credit cycle. And now we've started to re-accelerate some of those risks for inflation to the upside. And while the Fed has tightened, and to their credit, they've tightened pretty aggressively if they were operating in a vacuum, because they're not, and because of the limited set of tools they have to effectuate monetary policy outcomes and economic and market outcomes, in essence, they've done very little but hurt the bottom half of the K in the K-shaped economy, whether that's the bottom 2 quartiles of consumers, small and medium-sized businesses with those revolving lines of credit, whether it's the regional banks or some of the other, smaller borrowers out there. That's where the pain's being felt. But on the other side, for the wealthy, for the larger companies, for, pretty much the federal government that doesn't really worry about the collective impacts of deficit spending until it eventually hits, they're in a completely different world. And so, it depends on how we view the economy. If we look at it in just aggregates and things look great, or if we break it down and distill these different data sets and we see some red flags in other areas that look really strong. But at the end of the day, that fiscal impulse more than papered over the tightening of the Fed. And in the longer term, that's a mistake. Basic economics would tell you wait till the recession gets worse, respond in size then, rather than create this slack that'll be harder in the future, especially when you have this higher debt service cost to respond to whatever may come next in the form of an economic slowdown.
So if the Fed either raises interest rates or keeps them right around where they are, I would argue that the Fed is more or less trapped, that they don't have good options. And a lot of it is because of the amount of spending that DC, both political parties in Congress and the White House, want to do. Because the spending projections for fiscal 2025, they're over $7 trillion. And that's not even counting the interest payments on the national debt, which it looks like, according to estimates from the Bank of America analyst that tracks this, he's saying it's going to be over $1.5 trillion per year just in interest payments by the end of 2024.
And it's interesting, and because what we're looking at is China's no longer a big buyer of that debt. So the Fed's had to ease off the gas pedal on quantitative tightening, right? Part of that has been that liquidity in Treasury markets wasn't that great. The Treasury also doing their buyback program similarly to try to improve that same liquidity. That's actually their stated goal. The Fed wasn't quite as clear about it, just saying they want to continue to run down the balance sheet just at a slower pace. But yes, the government is kind of stuck. Because on the one hand, if they take their foot off the gas on this spend, then the economy realizes in very real terms just how much growth has been directly and indirectly reliant on it. And that would lead us to a period of significant slowing, if not eventually a recession. On the other side of it, however, there is a point where the law of large numbers starts to take effect. And it's like you said, those interest payments, assuming interest rates stay similar to where they are over that time, could be $1.5 to $1.6 trillion year over year, which is an enormous part of the overall budget. It's actually prompting, ironically, some concern from Janet Yellen, who really one of the reasons the interest payments are going to be that high is because this whole debt financing situation wasn't really handled as well as it could have been. A lot more of the long end could have been financed at those COVID lows. And while it would have pulled some liquidity out of the system, at the same time, it would have helped the government's finances over a longer time period. And so unfortunately, now we're dealing with the reckoning from that, and then all this fiscal excess. And of course, that tightening of interest rates, all leading to an environment where that debt service cost becomes something of concern because it's likely to rise at a time where we could see the economy slow and where some of these bills, these spending bills, are likely to kind of run their course, like the Inflation Reduction Act and the Chips and Science Act, sort of slowing over the years to come, and then a potential change in guard, at least a new Congress, potentially a new president as well. And we don't know what all that might do for where money is directed in the economy or what its impacts may be on the economy. But what we do know is there's greater forward-looking uncertainty as we get into 2025. So to say that this path that we're on is sustainable, over the long term in 5 or 10 years, it's not. It becomes ever more perilous the longer we stay on it without some kind of, smart austerity. And there's plenty of opportunities to cut. There's plenty of opportunities to be even refinancing the longer end here. You can still pay less for 10 years than you do for 1 month, right? So if I was a borrower, I'd be going out and trying to refinance my debt over a longer time period. Will it pull some money out of the market during an election year? Sure. Is it fiscally prudent? Yeah, it's becoming more and more necessary as time goes on. But what we're also seeing on the other side is the treasury market just doesn't have the appetite for those longer tenors.
And it also looks like a lot of governments and central banks that their governments and their central banks are going to have to let inflation run hot. And it looks like the rumors, at least over the next month, that the Bank of England and European Central Bank, ECB, they could potentially start to cut rates and let inflation run hot. Do you think that the game plan for a lot of these different governments and central banks with too much government debt is some type of yield curve control where they let the real inflation rate rise above the government bond yield?
So I think that when we look at the euro area, I actually have to give Lagarde a bit of credit because I think she's done a better job than the Fed in many different respects. One of them is that she's been more transparent. No one at the Fed that I've tracked has talked about how fiscal excess is one of the drivers of reacceleration of inflation. In fact, I heard Barkin say it's all to do with the consumer, that they're willing to pay higher prices. Well, everything out there, particularly for the bottom 50%, strongly suggests otherwise. Meanwhile, Lagarde and other ECB speakers have actually blamed fiscal excess on why inflation started to peak back up. They've also done a better job overall, particularly in a much more interest rate sensitive economy, controlling rates and inflation. So, headline inflation in the euro area is down to 2.4%. So I would argue that they actually can potentially cut rates with some degree of credibility versus the US, where we still do see inflation levels, quite a bit firmer in due to no small part because of what we've seen with this idea of this late fiscal excess being really the most profound in the United States versus some of our peers. So I'd say ECB has cover to cut. I do believe they'll cut this summer. I think they'll probably cut 50 bips at the very least, and that will add more excess liquidity to the global financial system. And that is something for us to kind of be somewhat concerned about, I would say. The ECB, though, at 2.4% versus US headline at 3.4%, that's a difference of 100 bips. So at least they're in a position where they can lean in and say, look, we're going to cut. We need to cut before the Fed. We are more rate sensitive than the US. We don't want to see a financial institution over here get into trouble. So at the same time, and we also have a lot of countries that are really not great at budgets. So they need interest rates to come down for other reasons as well, for some of those more aggressive debtor nations. So I think that they have room to cut. I don't know that inflation is going to come back to the Eurozone the same way, that it has the United States, unless that fiscal impulse becomes as excessive. Now, I would say the UK is kind of between the Eurozone and the US. They may cut a little bit too early. And, this is sort of central bank policy mistake 101 is, you really want to let inflation run its course. But I do think that they're in a better place to cut than, say, the Fed is, right? The Fed, if they do cut, I think they may cut, around, let's say, September, maybe November. But I think that if they cut, they're probably only going to cut once or twice this whole year, whereas the Eurozone probably could cut twice just over the summer. Now, if we go to the UK, their year-over-year inflation rate's 2.3%, right? So it has come down quite a bit month over month. We don't know if that's a blip or a trend. ECB, their inflation rate in the Eurozone is lower, for several months. So they have maybe a little bit more clarity that this is a trend versus UK. We're kind of waiting for this to manifest. But we have seen a bigger slowdown in the UK economy. We have seen some encouraging signs. So I think the Bank of England is going to pull the trigger on cutting probably 25 to 50 basis points over the summer. And that also feeds into that global liquidity excess. And it does increase that right tail risk for inflation, that it could accelerate further from here because the cost of demand as serviced by debt is going to come down in a lot of key parts of the global economy, not just in the developed parts of Europe, but also in a lot of developing countries. We've seen that rate cutting cycle really lead the developing central banks.
So if you do see rate cuts from either other G7 countries or emerging markets, wouldn't that also keep the dollar relative to the other currencies relatively strong? And then would that also bring a lot of additional flight capital, maybe from generalist money managers or institutional investors back into US stocks or US Treasuries then?
So I do think that's a great point. I think there's another tailwind there as well. And that is that when we look at the flows of commodities, seasonality in June and July over the last 20 years favors upside in the commodity index by about 75% of the time in June and July. And similarly, just in excess of 60% for crude during those 2 months, that these are up months. So there's a strong chance that you have that tailwind. And we've already had some of that move in commodities leading into this. Now, there's about a 1.5 month delay between the moves in commodities in oil and in the commodity index and when you've seen that push up interest rates, right? So that kind of has this effect of the moves in commodities feed through to PPI and then CPI. The market has higher inflation expectations. Rate starts to push higher with some degree of delay. And then that drags the dollar higher, right? The 10-year note, its yield really has an effect. It's strong correlation. I think last time I checked, it was 0.92 on a rolling 20 trading day basis, that it pulls the dollar higher as well with like a 1 or 2 day lead time at best. And so, I would say that, yes, there's both the central bank expectation and realized rate differential that's to come, and the inflationary tailwind that can push rates higher, and that can also drag the dollar higher. So there's that double barrel shotgun. And if you pull out a technical chart of the dollar, you can kind of see it's hugging this lower trend line here. So as long as it defends that, I think there is some room. I also think just from that macro tailwind perspective, as we've been talking about, those two catalysts are also pretty powerful. And I don't think that the move in the dollar is necessarily over, particularly if the ECB is going to lead the way in cutting, both in terms of size and when they start cutting. That portends to the euro weakening, and the euro is about 70% of the US dollar index. So when you have the ECB cutting, that's a huge chunk of the US dollar index starting to potentially weaken in comparison because of the perception of not only are they now in a cutting cycle, but there's likely more cutting to come, and their ultimate rate may be lower than where the Fed goes.
So it sounds like you see a scenario playing out potentially if there are the rate cuts from the other central banks, where the dollar on a relative basis could continue to at least move higher into a higher part of its trading range or go on a little bit of a rally against other currencies. But I think the different part here, and a lot of the bond bull market people, they've been buying TLT expecting this. They've been expecting the managed money or the other central banks to go back in and start buying a lot of US Treasuries. But we've seen evidence that a lot of the larger purchasers of US Treasuries for decades now, whether that's Japan or China, they're net sellers. So there's demand for dollars, not as much demand for treasuries. It looks like Japan or China, they continue to sell. And it looks like a lot of those trade surpluses, foreign exchange reserves, instead of going into treasuries, they're going into gold.
Right. They're going into gold because in 2022, the Western financial system became pretty apparent to the rest of the world as something that if you don't do as what as we say, we'll sort of cut you out of SWIFT, we'll cut you out of global settlement, we'll create a lot of pressure on your currency and your economy. And so countries started to lose a little bit of trust, and that implied bid for treasuries and for some other dollar denominated assets was eroded from some of these foreign counterparties, particularly China, Saudi Arabia, Russia. Russia didn't really have a choice, but they've been walking away from our treasury market for over a decade, kind of seeing some of this coming, perhaps. And I think that does, on one hand, especially decrease the demand for treasuries. On the other hand, though, U.S. assets continue to be some of the most attractive in the world. When you look at our equities, you have over $27 trillion of foreign capital parked in U.S. equities. You have, a significant amount parked in U.S. real estate, whether it's residential or commercial or industrial. And I think that trend continues. I just think there's more reluctance in treasuries. The other reason is, again, going back to, looking at any duration in treasuries, why would you want to go beyond a 52-week bill? Because at this point, you're not getting paid any kind of term premium. So there's just no reason. For me, when I look at interest rates, to me, they represent the risk of depreciation of the underlying currency, the risk of default or other kinds of unpleasant events that could depreciate your ability to get out at break even or with a profit, and then any kind of premium I want to make above that perceived risk. And if I'm not getting a premium above that perceived risk, and there's no term premium involved either, I don't want anything to do with it. And I think a lot of other treasury managers are looking at it the same way. Like, look, we'll park some money in bills. Bills are still quite popular and well absorbed, but we're not going to go for any longer duration because there's just no reason. There's nothing compelling saying that this is a good risk that I think buying a 10-year at 4.5% is going to be something I'm going to want to hold over 10 years. It just, to me, it doesn't really scream value. And I've heard fixed income folks coming on Bloomberg, continuing to say the same thing over and over again, that there's, like you said, there's going to be this kind of demand for treasuries for one reason or another, but none of it seems to come to fruition. And I would argue that the folks that are on the other side of this, I think Jim Grant's one of them, and I'm of a similar view, that we're actually in a secular bear market for treasuries. We had a multi-decade bull, and all the forces that led that to be are over. The period of, long-term sustainable disinflation is over. We went from abundance to scarcity. Scarcity implies higher rates. It implies higher prices. It implies, inflationary pressures potentially remaining sort of higher for longer, leading rates to stay higher for longer. And a lot of that means that diminished bid, particularly for the long end, could be something that's here to stay.
Yeah, I agree with that. I think we're in a long-term bond bear market. We might have some rallies here or there, but in terms of the budget deficits blowing out, I heard something very interesting, a statistic from a hedge fund manager, that the U.S. national debt has roughly doubled over the last decade or so, so an additional 17 plus trillion in the last 10 years. But foreigners, so China, Germany, Japan, the countries that bought a lot of our treasury debt over the last couple decades, they have not even added a net $1 trillion. And now just in the last, 6 to 9 months, Japan has had their own currency problems. It looks like they may have to, if they want to continue to defend their exchange rate, they may have to either liquidate treasuries or post treasuries as collateral to try to defend their currency. And China, I think just in the last couple months, I think they sold a record amount, I think $400 billion worth of treasuries.
Treasuries and agency backed debt, mortgage-backed securities, they've been pretty big sellers there. And it was record, like you said. And, it is a big concern. It does portend to the sort of rolling bear market in treasuries with plenty of head fakes to get people sucked in. But I think the 60-40 portfolio is essentially dead for now, unless you're parked in very short-term fixed income securities, or you're diversifying into things like, AAA tax-free munis and AAA corporate debt. But those are the only longer duration, debt securities that I really want to have much exposure to here. And then you could also look at some of these partnerships in energy and otherwise that have higher yields and some of the safer dividend stocks. But, in terms of long duration treasuries, I just have no interest in that area. If I want, to kind of have longer duration exposure, I'd rather have like a utility stock, because a stock like Dominion, for example, has catalysts to tell me it can continue to pay its dividend and have have my shareholder committed capital appreciate over time. And I don't see anything like that in treasuries. Treasuries now have to compete with companies that have better long-term outlooks and lower risk profiles. I mean, you talk about that same period, that 17 years or even 15 years, you're talking about a period of time where the Fed was the largest bidder at treasury auctions. And that's no longer a thing. And that you can see the effect on rates. It's pretty big. And so I think that's the other part of it is that, inevitably, and the Fed sort of realizes this with how big of a step down in quantitative tightening they've done, they're going to have to come back to the punch bowl. At some point, they will have to be a bidder again. It's not because they want to, it's because there's now a systematic need for it to happen, particularly because the last, several administrations have completely blown out the debt. I mean, it really, started George W. Bush, Obama continued it, Trump continued it, Biden continued it. It's bipartisan. Everyone is just irresponsible with spending. There's no attention to balancing this budget. And unfortunately, it does lead us down a path where we have to be much more tactical about our fixed income and investment exposure, because now we're in a very, very different environment, one where interest rates are likely to stay at levels that might seem elevated, but are actually closer to historical norms.
So if I could summarize what you just said in easier to understand terms, there's a serious supply and demand issue developing in the treasury market. And at some point, the Federal Reserve Bank will have to be the buyer of last resort, which means debt monetization or yield curve control. And the Fed calls that quantitative easing, but really it's just balance sheet expansion. And the PhD economists at the Fed call it an asset swap, but it's really creating newly created currency units out of thin air to buy government bonds.
Yeah, I mean, so they could effectuate this in a number of different ways. Like, they've also done Operation Twist, where they sort of shift up the composition of maturities on their balance sheet. So maybe at some point they could say, well, if the long end is blowing out, we're going to let more of our bills mature, and with that liquidity, we're instead going to, buy longer end assets at auction to slow the roll off of the balance sheet or even start to build it back up. And then they could also be net adders of liquidity if they wanted to get back into sort of so-called QE or other ways to try to control that. But I would also note that post Great Financial Crisis, QE was not necessarily always interpreted by the markets the way that the Fed may have wanted to see it. There were plenty of times where they would be engaging in this and yields would be moving in ways that were kind of counterintuitive to what programs they were running. So I would go ahead and go out on a limb and say, look, at the end of the day, what we learned in 2023 was a very important lesson, that the market is much bigger than the Fed. Now, everyone who's been in the market for a long time knows this, but a lot of people always assume just don't fight the Fed. That's the mantra. We go with it because for a long time it worked until the government fought the Fed. And, the market then fought the Fed. And the market arguably in many ways won in that sense. Now, if you zoom out as to what that means, it has the opposite effect as well. The Fed could go into an environment where they're easing, cutting their funds rate, buying increased treasury exposure or shifting up the maturities on their balance sheet, and yet rates keep rising because the market is much bigger than the Fed. And as a result of that, if the market disagrees, and let's say it disagrees because inflation is still, unacceptably high, then it could diverge from what the Fed wants to see in terms of realized outcomes across the yield curve. And I think this is the biggest risk. It's not so much that we have, less demand for treasuries over time and yields come up to a point where naturally, eventually they become attractive to market forces, because that's what you really want. It's actually the opposite, that the Fed continues to be this command control apparatus trying to set the trend for the economy, for interest rates and otherwise, which, quite frankly, is the antithesis of free markets and capitalism and everything we're supposed to stand for. This is very much central planning and authoritarian and otherwise, but that goes the opposite way that they want to, just like it did in 2023, where, their policy outcomes weren't necessarily what they wanted to see for inflation or asset bubbles or home prices or otherwise, that those same policy outcomes they want to see on the other side in easing aren't realized because inflation is entrenched and it's too high. And I think, and also there's that lack of demand from overseas. I think those are realistic risks that we have to consider. In fact, there's so much so that there is some policy consideration in DC of telling banks, hey, you don't have to count treasuries on your balance sheet as an asset that goes against your leverage ratio. So you can just kind of build up as much as you want. It's the same as cash. Like there's this idea that we're going to try to massage this problem of demand out of the financial system one way or another. And I can believe it. I could see all kinds of different ways to try to delay the inevitable. But you can't stop it. Those laws of large numbers, eventually over time, this deficit spend and these higher rates are going to have an impact. It's going to bring the Fed back. And the question will be, where are we with inflation? Where are we with the economy? And is there going to be an appetite that the Fed can lead? Or is it going to be sort of like the inverse version of 2023, where they cut, but the market tightens for them because the market doesn't see what they see or want?
I think also what's confusing a lot of mainstream generalist money managers. So these are like hedge fund managers with like a typical Wall Street resume, or a portfolio manager or bond fund manager at a large bank that is a generalist that's allocating to stocks, bonds, maybe a little bit into commodities, or very little or none at all into commodities. Is it really, with a relatively strong dollar and the Fed keeping rates high, not giving the stock market cuts? Is that since November, you've seen a lot of commodities, copper, gold, many others start to rally when it looked like they could potentially crash. I mean, I was speaking to generalist hedge fund managers October, November, December, and they were telling me that they were starting to short all of the commodities back then. And they thought that, like, with a strong dollar, with the Fed keeping rates relatively high, that inflation had topped out and that commodities were going to crash. And the opposite has happened. And it looks like a short squeeze, in addition to supply and demand fundamentals that we discussed with some of the other commodities earlier in the interview.
Yeah, and as we talked last time, Jason, and as we've been covering over at MacroVisor and Trader A, we've been very bullish of commodities this entire year, and really energy going into late last year. And some of these key themes, in addition, adding in, aerospace and defense, and later this year, utilities, these are all themes that work within that framework of they're a little bit contrarian, but they're also where the real action is happening, where the real supply and demand fundamentals are meeting the price action in the market. And my mantra is macro plus momentum equals opportunity. So for when I'm setting up swing trades and investments, I really need to see both. I can feel I'm right, but it doesn't matter, because if the market doesn't agree with me, I'm not ready to start committing capital to that idea. And I'm not ready to necessarily share it with others that might be tempted to do the same. And so I tended to see what we were having happen, say in December, for example, that reversal in crude, that was extremely bullish to me. And that was a reason for me to want to get long energy companies, just like we started to see metals really breaking out this year. That was a reason for me to want to get long, silver miners, copper miners, platinum, and some of these other areas of the market as well. And so I understand how sort of old Wall Street's thinking about it. They're thinking about it from the terms of, the last 20, 30 years were disinflationary. All these inflationary pops are anomalous, and you can, fade them, and we go back to the sort of disinflationary normal. But all the fundamental underpinnings of that reality are in the history in which it existed. They no longer are present. And I think that that's something that's going to take a great big adjustment. And so I think these are secular shifts that favor old economy industries like energy, industrials, materials, metals, and mining. And for different reasons, utilities and aerospace and defense over a longer time period. I think these are investable themes. I think they're investable over a long time period. I also think that commodity exposure in aggregate for investors is far too low, and diversified exposure to commodities in aggregate is an interesting opportunity where we are. While they've run, I think they have a lot more to run over the next 5+ years, and there'll certainly be, speed bumps along the way. But at the end of the day, you see a lot of the same theme, that even though inflation is coming back and we've seen prices on the rise all over the place, policymakers, for whatever reason, feel like this is a good time to start easing. And that easing, wherever it's happening, has a global impact. And that global impact is one that's likely to lead to, again, the same thing we saw: higher rates, higher dollar, and higher commodity prices. But what maybe some of these fund managers were missing is that rates move higher in reaction to commodities a lot of the time. That the dollar moves higher in reaction to rates. And so if inflation expectations and economic expectations are rising, so too are interest rates. And that generally is something that benefits these late cycle themes. So I am a big advocate of full cycle investing, of looking top down and bottom up, and then qualifying that with the macro. So macro fundamentals, momentum, that's sort of the trifecta for how I look at the markets. And I think that for all the folks out there that are more traditional in their management approach, which is just more bottoms up, just fundamental driven, and not really full cycle, not really momentum, it may behoove them to consider those other elements. That's our core theme at MacroVisor as well. We've actually been taking on more institutional clients to that effect because we have seen more folks, quite frankly, needing a little bit of help to improve their returns in this environment.
And let me also add that the conventional economics textbooks, so that even the ones at the top business schools, they teach for central bankers. The playbook is if they raise interest rates, that kills demand, that slows down the economy. It's supposed to cool off inflation by killing or destroying demand. Well, now we're seeing this in hindsight. The textbooks don't teach this. It's also destroying supply and creating chaos. So if you're a small business owner or you're a mining company and you want to build a copper mine, and all of a sudden the interest rates go, the 10-year US Treasury yield goes from like 2% up to like over 5%, and your cost of capital is going to be way above the 10-year US Treasury yield to build out a couple $1 billion copper mine or $6 billion copper mine. I mean, the cost to build something like that, to bring on new supply, it's insanely higher compared to what it was a couple of years ago. So that it's either delaying or destroying potentially supply with the higher interest rates too.
I love that you said that, Jason. That is such an important point. And it brings me back to me saying something very similar during the hiking cycle of 2022, that sort of the irony of this is that while high rates destroy demand, they also destroy supply, like you said. And it's going to have an impact in one or two ways of inflation. Either companies can absorb that and pass on that cost because they have pricing power, and that's cost push inflation, or it limits supply. And in that case, demand, if it stays the same or firms up, means higher prices. So either way, higher rates on the supply side are not an elixir. You need fiscal stimulus. So my whole theory this whole time has been the Fed needs to tighten aggressively while the fiscal side expands supply and not demand. And they've done the exact opposite on the fiscal side. Obviously, that's all been demand-driven policy that maybe someday increases supply. But the problem is we need the supply here and now. We're not getting it. The fiscal side has been negligent on supply-side economics for really decades. And now those chickens have come home to roost. And the people in power in DC, whatever party they might be in, they don't even understand this concept that they really need to expand supply for anything to be even remotely resolved over a longer time frame. Instead, politics are all about, kicking the can and that next election. And the best way to do that is to essentially indirectly bribe your voting base and your lobbies by giving out demand boosting stimulus, which is unfortunately the opposite of what we need across the board. So I love that you mentioned that, because that is one of those unrealized things. And, it's even worse when you raise rates and boost demand, because then you get that double whammy impact that we're seeing now.
And meanwhile, you have record stockpiling by China and India of copper. They just continued to import over the last 5 months enormous amounts of copper, way above normal trend. They probably realized that scarcity is a function of price. So if they were accumulating copper at $4 a pound or lower, they were getting it really cheap, because in the future, I mean, there's not going to be a lot of copper supply at sub $4 a pound because of higher interest rates, lower ore grades, all the other input costs, labor costs, all the other, we could talk probably for an hour about all the issues that miners have to deal with all the cost rising and ore grades falling. It's looking like we're going to need probably at least $5 or $6 a pound copper in the not too distant future to incentivize miners to bring on new supply. And it's not going to stay there for a couple months. I mean, the copper supply is very slow to react to higher prices. It could take years to bring on new supply.
I agree, and I think $6 is easily where this thing heads over the next year or two. And I think that it's a big tailwind for copper miners. But like you said, it takes a long time to bring new supply on. And in the meantime, we have structural deficits that continue to grow in copper, also in platinum, and in other key metals. I think this is something that is going to lead to higher prices, both in terms of what companies have to pay and what is passed on to consumers. And so this is a change. A lot of these are phenomenal phenomenon that the developed world has not faced in some time, and particularly the United States, which brings us back to why so many are sort of ill prepared for, well, what do I do rather than just buy the biggest stocks in the S&P or the most hot tech companies? Well, it's going to require kind of revisiting some of these classical full cycle themes, some of the components of value investing. God forbid we dust off that book, right? But really we have to, and really also looking at commodities and commodity producing companies and the intermediaries that have pricing power, because I think we're in a completely different environment. It's one that is going to take shape over the next 5 or 10 years rather than the next 5 or 10 months. And so this is something we kind of have to get used to. It's sort of big change in the guard, and there's going to be big winners, there's going to be big losers, and there's going to be a lot of changes, I think, in passive investing as a result of this as well, because quite frankly, the leadership of what led to the point we're at right now may not be the same leadership we see over that same next 5 or 10 year period. I would wager that we're likely to see a sort of change in guard from some of these companies, particularly the ones that have become a little more stagnant like Apple, and into newer themes that are back to old themes, right? The idea that energy, industrials, materials, metals, and mining, that they kind of become the areas where there's greater revenue and earnings growth over time out of necessity. And out of necessity, investors begin to park capital there, and these start to become the parts of the market that outperform their underlying indices. And that makes it a more stock pickers, active investors type of market than a passive investor or growth investor type of market.
It also looks like foreign investors, especially in Asia, with how weak a lot of the Asian currencies are, the Korean won, the Japanese yen, others are hedging currency debasement in their local domestic currencies rather than necessarily buying a lot of US Treasuries. They're buying commodity exposure, Bitcoin, so gold, silver, Bitcoin. Those things have been trending as the Asian currencies have been weaker. The demand spike for physical gold has been in the retail sector since October, November, December up to present, for Asian gold demand, whether that's China, India, Japan, Korea, Thailand. I think a Thai pension fund just allocated a massive amount of physical gold, and then also in Vietnam. So that's where the gold demand driver, the big spike, has been coming from. I think like here in the West with GLD and other Western investors, retail, I mean, people are liquidating their gold. GLD, the demand by institutional investors and generalists, they're not allocating really to the normal gold exposure. It's the demand spike is solely from retail investors in the Eastern countries and emerging markets.
And central banks as well, record gold buying from central banks, which we sort of touched on earlier with that shift away from US Treasuries. And I think it's a very interesting shift in guard. And I think it's something that is set to continue. And, eventually US retail investors might hop on that bandwagon. The institutions, however, have been so thoroughly underallocated to gold and all the other kind of peripheral types of assets in the space, like gold miners, for so long that it's going to take quite a shift, a multi-year trend for these guys to start to take notice, because they couldn't hate precious metals and be more underexposed than they are. Now, that's the writing of a good bull thesis should the momentum continue, because it is likely eventually they say, hey, I don't want to miss out on this anymore. But I do think that this kind of goes back to this broader theme of folks relearning how the economy is structured, how much has changed, and where some of those key beneficiaries are going to be, both within asset classes as well as sectors, industries, and regions, and how this isn't like it used to be. And also from those Asian countries, I mean, what Japan has been trying to do to defend its currency is very troublesome. I mean, none of these interventions can last for a very long time. So all they can do is degrade their foreign currency reserves, start to eventually sell off US assets in a naive and troubled fight to prevent further depreciation in a currency that is part of the most easy central bank in the world. I mean, there's no one more easy than the Bank of Japan. They own over half the country's debt. The government owns over half the country's central bank. And this is a country that's running over 260% government debt to GDP, with government debt at about a 1% yield on a 10-year. And that's like a multi-decade high. it's absolutely egregious. If we think there's no term premium or appreciation for risk and yields here, don't look over to Japan, where it's so thoroughly distorted that the central bank also owns a huge chunk of the stock and ETF market, as well as a large trough of corporate debt. So I think that they're stuck. They can't really, shift policy more in towards of tightening. So the yen is the sort of the de facto global carry currency. So is the Swiss franc for similar reasons, and I think that unfortunately that means that there is likely to be less demand for US Treasuries from Japan, which was for a long time one of the premier foreign buyers. And it's actually more likely they have to, not that they want to, but they have to sell off some of that exposure to continue to defend their currency. And all they're really able to accomplish is slow the rate of depreciation and scare out some of the lopsided leveraged longs occasionally, and some of the really aggressive carry traders occasionally. But that's about it. The primary trend remains down for the yen unless and until they actually get more serious about considering tightening, because they really haven't done anything that even vaguely resembles tightening in decades.
And for years, the Bank of Japan people, the people in the Japanese finance ministry, wished for higher inflation. They didn't get it, according to their own government economic data, although I think there was anecdotal evidence that there was a lot of shrinkflation. I had listeners in Japan sending me pictures that food items were shrinking. But now the gold price in Japanese yen, I think it's up at least 160% in the last couple of years alone. So it is starting to, it looks clearly that there's currency debasement in Japan and that there's a gold bull market in a lot of other currencies. It started ahead 6 to 8 months ago last year. A lot of the gold price was breaking out. It was at or near all-time highs in every other currency but the dollar. And finally, the US dollar gold price is starting to catch up.
Yeah, and I think that the other one that'll be very interesting to pay attention to is silver. I think silver is likely to catch up to gold. That is to say, gold made new all-time highs this year. Silver hasn't made new all-time highs since 2011. It's quite a bit below its 2011 highs of just in excess of $48 an ounce. And I could see silver really violently catching up to gold, as it likes to do, catching a lot of folks off guard, having these big parabolic moves and then sort of settling. And that's one reason I'm very constructive on silver. The other is that both investment and industrial demand are on the rise for the metal, and those are trends that are continuing for similar reasons as copper. The other thing with copper is that over half the demand comes from China. As long as they're stimulating there, that copper demand could stay robust outside of the stockpiling. There could be building out of generative and transmission capacity there as well. So I think there are a lot of reasons to be bullish on the metals. I think there's a lot of reasons to be bullish on grains, especially wheat. I think there's a lot of reasons to be bullish on energy. And I think there's a lot of reasons to be bullish on the old economy stocks, because at the end of the day, we're in the beginning of this shift. This is a longer term secular shift. The vast majority of managed money is not prepared for it, which means there's a huge opportunity ahead if I'm right. And so far, all the trends kind of point in the direction of this being something that sustains, because policymakers, whether it's on the fiscal or monetary side, continue to make the same mistakes that kind of build into this theme. And then on the other side of it, you've got all this increasing demand for energy, reshoring of manufacturing, AI, increasing cloud usage and data center utilization, EVs, et cetera, also driving a lot of this demand. And so I think at the end of the day, that theme of shifting from abundance to scarcity is something we all need to take into consideration as investors, because there's great ways to capitalize on it while simultaneously hedging against the inflation that we can expect that may continue to debase the purchasing power of our dollars or whatever our native currencies are.
So for generalist investors, they're going to start paying attention to companies and sectors, industries that start to beat earnings, top and bottom line, free cash flow growth. Do you expect then that the copper miners, the gold miners, the silver miners, starting in Q2, now that the gold price has gone from almost correcting and crashing around 1900 up to almost 2400 when we're recording this interview, it's rallied to $2,360 on Tuesday, May 28th, 2024. Do you expect that we're going to start to see some market outperformance for gold, silver, copper miners in Q2, Q3, Q4 going forward compared to other sectors and industries for earnings?
Yeah, for earnings, I think we will from the better run companies. And those are, it's going to make it very easy for investors to decide where they want to take their capital and where they want to leave. Because at the end of the day, the market is a voting mechanism, and capital goes to where it's treated well. So the companies that are well run, that are increasing top and bottom line, that's where there's going to be outperformance, both in terms of, realized performance and price, but also where earnings trends can continue from that Q2 shifting guard that we're likely to see. So my thought would be focus on the companies where there's stellar management, clean balance sheets, low to no debt. You're already seeing free cash flow growing, and where they've been prudent about how they're investing and spending, and that they're not getting into too much executive compensation and other kinds of things that kind of take away some of the incentives for investors to really get the kind of returns that they need. Because if executives are too well compensated, they're not going to necessarily be in line with where the share price goes. And so we kind of got to look at it from that framework. But I think in that sense, yes, there's going to be companies in all of those spaces, as well as platinum miners and otherwise, that should realize significant earnings growth, and as a result, share price appreciation over time as well. And those are going to be part of those long-term secular trends in these spaces, whether it's metals, whether it's energy, which I think will also start to pick up later this year, whether it's industrials and materials, where we could see that margin and revenue expansion really carry them to be market leaders, both in earnings and revenue growth, but also in stock price appreciation versus the broader aggregates.
So I have two more questions before I let you go. Maybe take a couple minutes for each one. Want to ask you about this rally in Chinese stocks. So for the domestic Chinese investor, the retail investor, or even the institutional investor, there was a number of articles out in earlier this year, January, February, from Financial Times, Economist, New York Times, talking about how the retail Chinese investor has lost faith in a lot of Chinese banks, Chinese real estate, Chinese stocks. But it looks like a lot of foreign investors, so private equity, hedge fund managers, have gone in and bought like Alibaba and other Chinese stocks. Do you think that this is just a short-term rally? Because when I look at the bank data, China just had record cash withdrawals from a lot of Chinese banking customers in April. So those two things, with a Chinese stock market rally and the domestic Chinese investor taking their cash out of the bank and not putting it into stocks, those two things don't really jive.
Right. And you just mentioned earlier that more folks are putting money in gold, putting money in Bitcoin. And I think that those are themes that, from the domestic flows of capital are likely set to continue. They're also taking it out of real estate, which had been their, kind of favorite piggy bank, even more than domestic equities. I think that's set to continue as well. On the other side, you have the government doing everything they can, but in effect, it's a Band-Aid, right? So it's a tradable pop. I don't think it's an investable pop. I'll be happy to be proven wrong, because the risks of China going off the rails are pretty significant. This is a very large real estate market. It's like a $55 billion or $50 billion global asset class. It's one of the largest asset classes in the world. So obviously, if it goes off the rails, that's really negative for the global economy. On the other side, though, even though the Chinese government and their central bank have done quite a bit on the fiscal and monetary side to try to kind of ring fence risk and even add some stimulus, it's nowhere near what needs to be done to kind of salve the giant hole that this bleeding real estate market has created. And I don't think they want to go too aggressive, because while they do enjoy a weakening currency, they don't want it to weaken too appreciably too quickly, because that creates other domestic inflation problems. And, between unemployment and inflation, those are the two biggest causes of unrest in China, if either or both get too high. So I think policymakers are sensitive to say, look, we need to make sure this whole thing doesn't blow up, but at the same time, we can't throw enough at it, because if we do, we're going to really destroy our exchange rates. So I think this is a tradable pop. I still think China is in trouble over the long run. And I think that it has a lot to do with really ineffective, if not incompetent, leadership. It's really been this sort of series of ham-fisted crackdowns against different industries. These were industries that, in many cases, captured the interest of younger people there, who were promised an economy that would be vibrant with tech and other kinds of growth industries that were much more part of that sort of digital frontier. And then, Xi's government went through and kind of one by one smashed them, whether it was education or gaming or AI or cloud or otherwise, one by one, and then into other industries, that were adjacent or just bigger sectors of the economy that were really important, like infrastructure and finance. There's just been one rolling crackdown after another, and folks don't know whether they're coming or going, but it's been this sort of trend over the last 3 years, and maybe it's over now. But there's still shell shock. There's also a lot of folks that are, justifiably concerned about what all is happening with their response to all these issues, why it's been so slow. We've been promised a outsized response for a year and a half. We've barely gotten anything. And so I think that for China, it's a great pop. It's a good place for, longer term investors who are skeptical to probably raise some cash and start to exit some of those positions, sort of like you're seeing the domestic folks doing. I don't think it's a longer term investment opportunity. And quite frankly, the other concern I have with exposure to China, when there's much more transparent, higher quality, better growth stories like India, for example, which is making new all-time highs. My concern with China is everything's opaque. It's all down to one man and what his mood is that day, week, month, or year, and how he may episodically destroy the market because something, irks him. I just don't like that kind of risk. I don't like the opacity. I don't like the room for scandal in a lot of these companies that we don't know what their actual financials are. We just know what they're telling us. And if you look at the book value in a lot of these Chinese banks, they're all trading below what they say their book value is because the market doesn't believe their book value. And that tells you everything you need to know, that there's a hologram and then there's reality. And so investors have to try to navigate between the two, and they have blinders on. And they're very, very myopic in the sense that you can't look very far out. You can't necessarily get a clear view of what the data actually is. So for me, it's more hands off. I don't mind trading it. Like I did some Pinduoduo trading just based on really large sweeps. We saw millions and millions of call premium coming in ahead of earnings. I figured someone knew something. I traded a bit of that. It's like basically a very short-term swing. And it worked out okay. But do I want to commit capital there for the longer term? No, my emerging market exposure is ex-China. I prefer to net it out. And I don't even consider China an emerging market anymore either.
And I consider the best way to play China more than betting on specific individual company. And you mentioned some of the red flags with their banks or ADR deposits that are listed on U.S. exchanges, how like it's a Caribbean shell company, and the shareholders, if you go through the prospectus, Jim Chanos and Kyle Bass and my friend hedge fund manager Emma Molman have talked about this in the past publicly, that the shell company, that's the ADR, doesn't the shareholders don't have a lot of claim on the Chinese assets. But I think the best way to play it probably long term for China for growth is let energy usage. They're eating more calories for food, metals. I mean, they're still going to need the copper. Probably the Chinese technology companies are going to want to build data centers too and upgrade their electrical grid. So I think like all those things with commodities plays and edging into those are probably smarter long-term performers than some of these Chinese companies with opaque accounting. But there's a lot of risk there to China besides just the rally. I agree with you on the rally. I think like their largest real estate developer, which is called Country Garden. You've had Evergrande, which everyone knew was a dead man walking. They did a strategic bankruptcy. The largest real estate developer, Country Garden, they just hired Kroll, which is an expert at strategic bankruptcy. So they're going to file bankruptcy. I don't know exactly when. I don't know if it's a couple months or 6 months or 9 months, but they will file a bankruptcy. And that's China's largest real estate developer. Obviously, the banks probably have bad loans attached to that too. So they're going to have to write those down and have balance sheet problems. That's probably why the bank stocks are trading below book, like you said. And then on top of that, China has the real estate bubble. There's a lot of Chinese over the last 5 years that took out mortgages and they're upside down in their mortgages. So they grew an enormous real estate bubble over the last 15 or 20 years. And normally they copy the Federal Reserve Bank, what we did. Well, not we, because I'm not in the government, but what the US government decided to do in 2008 and 9. I mean, there's a currency devaluation, debt monetization, and bailouts coming probably too to deal with their real estate bubble.
Yeah, and China doesn't enjoy the exorbitant privilege that the dollar has as a reserve currency, so it's much more steady as she goes. The bazooka of liquidity is much more constrained unless we're in a period of time where they have an opportunity to really lean in. Like if we had some kind of global liquidity crisis or economic shock, they could be more aggressive. But in the current environment, they have to be really careful because the last thing they want to do is aggressively import inflation and at the same time have the risks of heightened unemployment. We saw the last time when there was large social unrest in response to COVID's lockdowns, she buckled and changed his entire stance on lockdowns and COVID in general. It was almost like it never happened. But there's still that shell shock in the Chinese consumer. And so there's also a two-tier, again, back to that theme, K-shaped recovery in China. Their industrials are doing quite well. In fact, look at a longer-term chart, there's almost no blip on their growth. Retail, it's so far below trend from the pre-COVID level because the Chinese consumer just doesn't want to get out there. They don't want to spend. They don't feel confident in their economy. And what you said with them parking more money in gold, pulling it out of real estate, out of equities, putting more in crypto as well, that doesn't tell you they're confident either, right? They're seeking safety. Who can blame them given everything they've seen play out over the last 5 years or so? And I think, unfortunately, that's a theme for some time to come. Remember, all these free zones in the Chinese economy are really part of a grand experiment. And, they may end up being one of the things that's more transitory than maybe inflation.
And I think a lot of people are buying gold, silver, Bitcoin exposure in China. They're worried about a yuan devaluation. So I don't know what the devaluation would be if it's the Chinese government says they want 20%, but normally like these things tend to feed on themselves. So like in an emerging market currency devaluation, the government says, oh, we're going to devalue the currency by 20% or 30%. And normally the people just panic and it creates a run on itself. Now, China has a ton of layers of capital controls, but that doesn't mean that the devaluation could go as planned if China does try to do something like that.
Yeah. Yeah. I think that, this is a situation where the risks of policy mistakes are growing for key global central banks and for fiscal policy setters, whether it's in China, Japan, the United States, to a lesser degree, Europe, but still, there are risks there. I think these are things that we have to contextualize as tails. There's right tails towards greater inflation. There's left tails towards economic shocks. These are things that we kind of have to build into our investing framework because we can guard for these risks. We can diversify. We can try to produce more uncorrelated returns. But we also need to be aware that a lot of these policymakers are in a very tight spot. They're walking a literal tightrope that if they move too much in either direction, it can cause unwanted ill effects for the global economy. And that's especially true in China and Japan. And so those are two places where I think as investors and traders, we need to have a watchful eye. Now, Japan, they're kind of steady as she goes. We're going to run the yen down. We're going to keep buying our own debt. We're going to keep supporting our markets. That seems to be a theme that's set to continue. China is very timid in the sense that they don't yet, at least, want to really depreciate their currency much more aggressively than they already have. If you look at a chart already of offshore rates versus the dollar, it's already quite depreciated over the last several years. They don't want to increase that rate of change. And so they're okay with sort of the frog in the boiling pot approach, that slower rate of change, but they don't want something faster that starts to really import inflation and cause some of those imbalances that could stir up social unrest. And so that kind of tells you they're also sort of trapped, painted themselves in a quarter where there's no real way out from the current malaise. It's just more of a sellable pop. It's a tradable pop, in my view. It's not an investable environment. I'd much rather be in economies like India or Vietnam or Mexico or Malaysia if I'm going to have emerging market exposure, even heck, South Africa, than in China. Because I feel like the opportunities for risk are lower, reward are higher, and there's more transparency. And there's other investors that are seeing this as well, and they're moving their capital. And I want to be part of that flow, part of that momentum.
Well, Mexico and India are getting a lot of the factories that are leaving China, right?
Yes, absolutely. And so is Vietnam and so is Malaysia. So that reshoring is a key part of our theme at MacroVisor for liking some of these emerging markets and broadening our exposure and coverage.
Last question here before I let you go. So it looks like Nvidia and maybe like Qualcomm, a few other companies are the key leaders, maybe Taiwan Semiconductor. But I started doing some research on how many of these semiconductor fab factories are under construction globally. And this is partly because of the CHIPS Act that Congress passed. There's 70. So there's US and China, Taiwan, all over the world. There's 70 semiconductor fabs under construction now. Do you think that, I don't know, 5 to 7 years from now, there's going to be a way oversupply of new semiconductor chips? And that's going to cause good for consumers. Maybe you get a cheaper laptop, but it's bad for the companies that are going to be oversupplying the market.
That's a great question. And I think it depends a lot on the cycle. So like you said earlier, data center refresh rates were sort of every 2 to 3 years. We saw Nvidia shift gears now with the way that they're producing chips like Blackwell, is coming out later this year. They're going to realize revenue from it. And then they're saying next year they're going to put out another processor in the year after that. So their cadence is increased. They're going to be at a faster run rate for the production of new semis. And we're seeing other companies start to follow along with that idea as well. So the question is, what does the consumer do? Do Nvidia consumers buy new GPUs every year? Is the rate of change going to be that much and that much more efficient? And is it going to be worth it? And is there going to be that type of demand? Or are we going to start to see some market saturation? I would believe that unless and until we really see AI translate to bottom line margin expansion attributed directly to AI, that eventually this uptake does slow and we do run the risk of overcapacity. And it's governments around the world are spending to expand fabs, in the United States and in Europe, in UK, in China, in Japan, in Taiwan, and elsewhere. And so this is a trend that, yeah, we could start to see this get a little bit long in the tooth, 5 or 10 years when we have all this capacity online, because semiconductors are generally cyclical. Is it becoming more secular in nature? That's what we need to see, because this build out is assuming it is, but all the sort of history of semiconductors up to this point suggests otherwise. So the question now is past prologue, or are we in a different environment?
So listeners out there, if you're looking for a new laptop or desktop computer, you might want to wait unless your computer's about to die, because it looks like there's going to be an oversupply of brand new semiconductor chips and the prices are going to start to fall.
And certainly that would be a welcome change. I mean, the other part of that is, the halving of Bitcoin that reduces some of the demand for certain ASICs and GPUs as well. It also puts more in the market from some of these miners that are selling off inventory. So used products you might be able to get decent deals on in the here and now as that's being absorbed. But at the end of the day, technology is one of the few areas on the hardware side in primarily where you kind of have somewhat reliable trends of deflation. And I would be surprised if that doesn't continue. That is to say, hardware continues to get more efficient, and overall, the path for how much compute you're buying or how much storage you're buying or how much memory you're buying becomes cheaper over time.
But Bitcoin mining, correct me if I'm wrong, doesn't it burn through tons of like servers and semiconductors? It burns a lot of electricity. So the way the halving was designed, it was designed to be basically digital gold mining. So when the halving occurred, it becomes harder and harder to solve the problems for proof of work. And so the cost to mine Bitcoin is going to be more difficult. It's going to be more expensive. It's going to burn more electricity. It's going to burn through more semiconductors and servers, right?
Well, so yeah, the electricity usage would be expected to become higher, assuming that transactional activity is increasing, commensurate with that expectation. But on the other side of it, there's a lot of mining operations that simply can't make ends meet if their mining cost is in excess of $100,000 of Bitcoin and they're only getting paid around $68,000, $70,000. So that difference in aggregate is causing some of these companies, not because they want to, but they have to sell off some of this equipment, because many of these companies don't make any money as it is. So that margin compression is significant. And I think that creates the need to add into selling of some of the existing equipment. And eventually also, as ASICs become more efficient, both in power and in cost, in terms of what amount of compute you're buying, that does increase the demand for the newer tech to refresh some of this. So I'd say, in the near term, you have some of these mining companies. There's going to be M&A in the space. There's going to be consolidation. There's going to be hardware put on market because of the necessity to do so. A lot of these guys are on revolving credit or otherwise. But on the other side, looking out longer term, for the ones that are better capitalized, that are reinvesting in their infrastructure, they're going to want to buy newer chips because they're going to be able to realize lower aggregate power demand. Now, in terms of burning through it, it really depends on how they run their hardware. But what I see on the aftermarket is lots and lots of reasonable quality, used, but still they have life cycle left and they're trading, 30 to 50% below retail hardware. That's for crypto mining, like GPUs and CPUs and other boards that come on the market. And one can take advantage of that, particularly in aggregate at some of the auctions when these are being liquidated. So it just depends on where you are in the ecosystem, but there's always an opportunity to get cheap hardware, whether new or used. You just got to kind of know where to look and also be aware of where you are in that cycle.
Do you think that the trend for mining Bitcoin or Ethereum, is it going to be deflationary? Are costs going to fall? Or do you think that like basically the way Bitcoin was designed, that costs are going to have to rise over time for a lot of the mining because of proof of work and how difficult it is to verify the transactions with the harder and harder math problems and how less Bitcoin is available for the miners?
I think that ultimately the costs continue to increase for the miners. And that's by design for Bitcoin. Now, Ether, it's a little different. They can always change things as they go. And we're at proof of, stake now. So it's much different in terms of power. I think it's something like 95% less power intensive. But Bitcoin, as long as they stay on this path and they don't switch to proof of stake, it inherently is extremely energy inefficient, and it uses something like 0.05% or more of global electricity. So it's almost as much as like a European country like the Netherlands. And I think that's weird, because it doesn't really accomplish much. And so eventually, if we're in a world of energy scarcity and we start to look at where can we increase efficiency, you might see more regulators starting to poo-poo stuff like this, because they say, you know what, we'd rather use our energy to do things that help, whether it's heating homes or manufacturing products or building data centers, than just simply, playing around with these tokens that still don't have a lot of viable real world use cases. And I think that would be the sort of concern that I have for miners in countries that have these regulatory risks. These are things that we've already seen in some states and countries already, where there's been, discouragement, if not higher taxes or other kinds of regulatory consequences for mining. I think that's set to rise as energy becomes something that's scarce, that's more in demand, and that overall has to compete with other use cases that are probably more economically compelling.
But politicians are starting to run into this now, where if they come out and they say they're anti-Bitcoin or anti-crypto, there's a lot of voters that have been buying Bitcoin or Ethereum and have made a pretty good amount of money or trading these things or buy and hold hodlers there. So the politicians that are bashing Bitcoin or saying they're anti-Bitcoin or talk about how like it's not environmentally friendly, the voters are probably not going to vote for them, because you're starting to see the backlash now with both major parties, and then RFK being pro-Bitcoin, RFK Jr.
Yeah, no, I agree. It's not popular to be anti-Bitcoin, but I don't think anyone's going to run on an anti-Bitcoin platform. Instead, what I think is we're going to run into more reacceleration of inflation, and tough choices need to be made about these key areas that are driving it. And one of them will be the supply and demand of energy. And we might have to start scrutinizing where that demand is coming in and how we may be able to ameliorate that, whether it's increased efficiency or, slapping some regulations on some of these things that are using energy without necessarily providing a good economic return. So I don't necessarily think a lot of these decisions are made because folks want to make them. I think they're more made during difficult times for difficult reasons. And unfortunately, I think that's one of the risks on the regulatory side that crypto runs. We also have things like, eventually there may be quantum computing, and that whole blockchain and the SHA 256 encryption that backs it may not necessarily have the same viability. And then also, of course, these things rely on a overall free internet. If a large nation state or consortium of nation states begins to say, we don't like this stuff and we don't want it in our country or at all, there are plenty of steps they can take, even for decentralized cryptocurrencies, that can be highly disruptive, if not, even pretty well stop their flow, like null routing entire swaths of IP space of miners off the internet completely with BGP attacks over long periods of time could completely stop the flow of transactions, leave a lot of pent up selling demand from a loss of confidence. So I would just say there are still a lot of left tail risks in this space. I understand why folks are getting into it, but ultimately it evolved as a relief valve for excess speculative liquidity. I still think in many cases it is still that, because at the end of the day, if you don't know what it's worth, then it's probably the first thing you sell if you start seeing pressure on your portfolio and you have to exit from some of your risks. So I would just be looking at it from the perspective of, it's an alternative asset. It's pure psychology and momentum. It has the opportunity to run in the right case. And, we've been in that environment now with excess fiscal really driving global liquidity higher. But if that starts to turn the other way, you start asking yourself, well, what is this actually worth? And that's a hard question to qualify, because there's no valuation framework for any of this stuff.
Well, I also think in countries like China or Turkey, a lot of people are using Bitcoin or crypto as an intermediary to get out of the domestic currency if there's capital controls and get into another currency or assets in other countries. So they're not buying and holding Bitcoin necessarily. They're just using it kind of as an intermediary to get out of one currency they think is going to be devalued or debased rapidly into something else.
Right. It's a way to evade capital controls. And we are certainly seeing that for sure. That's one of the reasons a lot of countries with capital controls try to ban it. And quite frankly, if they really wanted to do more on that, they probably could. But I think they also realize that if they overstep, it could create more harm than good. So at the end of the day, those types of demand and supply flows are likely to stay intact. I just wonder over the longer term, sort of where this goes, especially as we see excess liquidity dry up and as we see more scrutiny of energy usage. But at the end of the day, I don't think crypto is going to go away. I just think it's going to potentially take a different shape in the future. And unfortunately, I think the outlook for global central bank digital currencies being a prevailing force in financial markets and economies is much more realistic than Bitcoin or Ethereum becoming the way that we settle debts globally.
Yeah, and I think Russia has talked recently about potentially banning Bitcoin or other private or decentralized cryptos. And I'm not sure if they actually have yet, but they've been discussing it. So they're one of the first countries to potentially do that. But for listeners out there, Mayhem has a tech background. So that's why I'm asking him these tech questions. Last question here. So I've heard someone else in the tech industry talk about like all the hardware and infrastructure that needed to go in to build out the internet with like high-speed internet, fiber optics, cables, the telecoms heavily investing in like capex to build out high-speed internet for businesses and retail people at their homes. Do you think that we're going to see a similar tech cycle here with like the data centers, all the electricity? I mean, Mark Zuckerberg, he's talking about, he did a podcast interview recently for Meta. He's talking about building out data centers that are almost an order of magnitude in terms of the electricity usage larger. Microsoft and OpenAI system are talking about spending $100 billion world-class data center with insane amounts of capex by 2030. So do you see a similarity between that capex hardware build out from the 1990s telecom high speed similar to now?
I do. I think we're in a similar shift in terms of acceleration because AI, as we know it, requires a lot more energy, a lot more compute, a lot more bandwidth. And so that means the scale of a data center, the amount of connectivity it needs, and the power input is much greater, as are the cooling requirements. And so that all kind of leads to a theme that as long as these investments continue from these larger operators, as long as the demand for AI continues, and especially if it starts to find more viable real world use cases that help companies expand their bottom lines, then yes, I think that cycle is more of a secular theme. And that's one of the drivers of my idea that AI power demand and really all the sort of beneficiaries from scaling in AI could bring about key beneficiaries in copper and copper miners, energy exploration and production, utilities in key regions like Dominion Power and sort of the East Coast, Silicon Valley, and Northern Virginia, networking hardware companies, switches, routers, perimeter security, data center services and solutions companies, some of the pick and shovel semiconductor companies out there. And then there's also going to be losers, companies that are involved with outsourcing, with data entry, with graphic visual design, web design, with paralegals that review complex contracts, junior researchers at finance companies, small to mid-tier companies that do not adapt or are heavily disrupted. Those are going to be potential losers. And look, no investment thesis is without its risks. So with this, if we have inflation pick up much more than what we expect at this point, that could lead to an economic shock that could disrupt some of this, particularly if interest rates start to move appreciably higher. On the other side of the pendulum, if there's a global recession, which eventually may happen, then that's a key risk for commodities in particular, just like hot inflation would be a key risk for AI and speculative growth. If geopolitical tensions continue to rise, particularly with China, that's a key risk for copper on the downside. It's a key risk for oil on the upside, bringing about that hot inflation risk. And then there's also large scale malfunction. What if really big AI goes on a tear and does something really unfortunate? And that has folks rethinking how and why they invest in AI. And also, there's another risk, which is less favorable regulation, which could come as a result of some large scale malfunction. So, anything is possible. But I think where we are now, if these trends continue, it does warrant a sort of secular shift in how we view a lot of these areas and where momentum is likely to go in the market. And I think it's for a lot of the beneficiaries that have been lesser loved up to this point and are starting to see some of that attention now.
And the other part of this is the energy component. So I think we could see a nuclear power renaissance come about because that's cheaper, stable baseload electricity. We probably need to invest in coal, especially if we're going to upgrade the coal-fired power plants to clean coal like China has done across the board. I think at a lot of their coal-fired power plants, they're still building, I think, one new coal-fired power plant per week at this pace, but I think they've retrofitted and upgraded their old coal-fired power plants because it looks like pollution is starting to trend down there, that they put in the clean coal scrubbers on the old coal-fired power plants. And then natural gas pipeline companies, I think like the senator from West Virginia, he was trying to get that pipeline approved to move the natural gas from the Marcellus Shale and Utica Shale down here to Northern Virginia, where all the data centers are. So I think EQT and some of the other companies are trying to buy pipelines to move natural gas from the shale deposits in like West Virginia and Pennsylvania down here to where the data centers are too.
Yeah, and that's going to be an important. I mean, look, we can't be choosy when we have this amount of aggregate power demand online. Everything that can supply power is likely to be built out. There'll also be more photovoltaic or solar and wind power generation coming online, which further increases demand for a lot of these industrial metals and for energy, since you got to pull all the metals out of the ground as well. So it's just a big cycle in its second or third inning that benefits a lot of these older economic players that aren't necessarily associated with AI beneficiary, key investment themes, but they are becoming that. And I think that's something that, for traders and investors out there that are either looking to capitalize on the reacceleration of inflation or this longer term secular trend in AI, there's a lot of convergence in those two themes.
You are a wealth of information, Mayhem. I want to thank you so much for your time. If my listeners want to check out the work that you and Aisha Tariq do, how do they do so?
Yeah, absolutely, Jason. And thanks again for having me back on. So you can check out our work at Macrovisor. That's macrovisor.com. That's where we do our institutional consulting. We also have a retail newsletter offering where we share our research for our subscribers, both free and paid. I really recommend folks check that out. The free newsletter has a lot of content. If you like what you see there, you can always upgrade to paid and add that as a way to complement your returns, your investing style, and your global awareness over time for a lot of these key trends we're talking about. I also co-founded TraderAid.com. This is for your higher frequency traders, your swing traders. It's all about education, tools, and an awesome community on our Discord. We've got some leading edge stuff that no one else has. That's also given us a bit of an edge in markets, particularly over shorter time frames, in futures, in stocks, in options, and in sector and industry ETFs. So I highly recommend checking that out. And for folks that are interested in TraderAid, I've got a 20% off coupon you can use for a limited time with the code Mayhem20. Just use that at checkout when you're visiting traderaid.com. And, follow me on my social channels. On Twitter, it's Mayhem4Markets. That's Mayhem number 4Markets. Same handle on YouTube. Same handle on Twitch. I do stream regularly as well. So, look at all the stuff I'm up to. If you'd like to support my work, consider becoming a paid subscriber. But anyway, always a pleasure to hear from folks. So consider visiting me in my replies on Twitter, my comments on YouTube, or shoot me an email, hello@macrovisor.com. Let me know what's on your mind and what you'd like me to be looking at in terms of the research I'm focusing on, because I like to hear what people are saying out there as well. I love to hear your feedback about what ideas I'm sharing as well. So really want to thank everyone for tuning in. And Jason, I really want to thank you for having me on as well. It's always a pleasure.
Oh yeah, this discussion was great. There was a lot of insights about that trend. I think that's going to be one of the most powerful trends is all the capex investment. So right now it's just talk. They haven't built out those data centers, those next generation, but there tons and tons of them are being planned. Right now here in Northern Virginia, there's press releases that Meta and Microsoft and Amazon, I mean, Amazon just bought another $250 million land package 30, 40 minutes outside of Washington, D.C. Microsoft about 9 months ago just spent almost $500 million buying a land package out in Manassas. So, and what they're going to buy, Amazon's going to build a university size amount of data centers. Microsoft, they're going to build data centers. So this is what they're spending the money on. They're spending the capex to buy the land, and then they're going to start construction probably in the next couple of years. But it sounds like that they need to put the equivalent of 2 new nuclear power plants here in Northern Virginia to supply those data centers with power.
Yeah, and I think that the power requirements in Northern Virginia for data centers are set to triple over the next 5 years. So it's going to be a very interesting set of opportunities here and elsewhere that feed into those key themes. And, I really appreciated the opportunity to have a conversation about this and to talk to your audience because I think these are things that we have to pay attention to as investors. It's not just Nvidia. There are a lot of other opportunities, and some of them are much earlier cycle.
Yeah, I agree, especially copper. I mean, it could take years, 5, 7, 10 years before we see a significant amount of new copper supply. And if the copper price goes back down to $4 a pound or lower, I mean, there's going to be a lot of projects delayed.
Yeah, absolutely. Just like if it moves above 6 and stays there, there'll be a lot more projects coming online, but they'll take years to really bring supply onto the market. So for me, I feel like copper is a secular story. I think the same is true of platinum. I think we'll see similar trends in some of these other areas that we've talked about as well with the key benefiting industries. So, as always, whatever is happening in the market, there's always an opportunity somewhere. We just have to keep our eyes and ears open. We have to keep our mind open, and we have to find where there are situations that the momentum and macro agree, setting forth the potential for longer term opportunities.